Every paycheck arrives with a destination. Not because you planned it, because an invisible current has already decided where most of it will go. Bills, rent, subscriptions, insurance, minimum payments. The money pauses in your account and then quietly continues its journey. For years, there was one stop almost everyone ignored: the savings account. It sat quietly in the corner of the financial world, paying almost nothing, too little to matter, too boring to notice. Something unusual is happening in 2026. That forgotten corner is starting to attract attention again. Not because people suddenly love saving, but because the current itself has changed.
Think of the financial system like a river. Every dollar entering your account is carried downstream. Faster the current, the harder it becomes to hold on to anything. For more than a decade, that river encouraged movement. Spend now. Borrow cheaply. Invest for higher returns. Cash was treated almost like wasted potential. If your money wasn't moving, it wasn't working. Savings accounts became little more than temporary parking lots. People stopped expecting them to do anything meaningful and eventually stopped looking altogether. But rivers change course, sometimes slowly enough that nobody notices. Over the last few years, borrowing became more expensive. Mortgages, car loans, credit cards, business financing. The cost of money quietly increased. At the same time, many banks began competing for something they suddenly needed again: deposits. Not flashy investments, not speculative money, simple cash sitting in customer accounts. And when banks compete for deposits, they offer something they hadn't offered in a long time: higher interest. Almost overnight, the savings account went from background furniture to something worth reading the fine print for. What's interesting isn't just the higher numbers. It's what they reveal about the financial environment. Think about this. If a bank is willing to pay you noticeably more just to leave your money there, it tells you something. Cash has become valuable again. Not emotionally, economically. Money itself has a price. And when that price rises, the entire financial landscape shifts with it. The same dollar suddenly has options it didn't have a few years earlier.
Yet most people barely notice because our brains are remarkably bad at recognizing slow changes. We're wired to react to alarms, not gradual trends. If your favorite coffee suddenly doubled in price overnight, you'd notice immediately. But if savings rates quietly climb over several years, many people continue behaving exactly as they always have. The old habits remain. Paycheck arrives, money sits briefly, and disappears. The system keeps running even after the rules have changed.
There's another reason. Modern life trains us to ignore cash that's standing still. Every app encourages movement. Tap, swipe, buy, upgrade, renew. Even investing platforms celebrate action. Green arrows, live charts, breaking news. Movement feels productive. Stillness feels like doing nothing. A savings account doesn't create excitement, it creates silence. And silence rarely wins our attention.
But here's where psychology quietly interferes. Humans naturally overvalue immediate rewards. A new phone today feels more real than extra interest accumulating over 12 months. Not because the phone is objectively better, because it's visible, instant, social. Interest grows in private. No notifications, no applause, no photos to post, which makes it surprisingly easy to underestimate. Imagine setting aside $20,000. A few years ago, the interest might have covered a nice dinner after an entire year. Today, depending on the account, it could be closer to enough for a vacation, several monthly bills, or a meaningful contribution toward another financial goal. The money itself hasn't become more ambitious. The environment around it has changed. The same dollars, following different rules, produce a different outcome.
This is where many financially aware people see something others overlook. They don't see a high-yield savings account as an investment, and they don't see it as a place where wealth magically grows. They see it as a waiting room,
but not an idle one. Productive waiting room. Money waiting for a home, waiting for a down payment, waiting for taxes, waiting for an emergency, waiting for an opportunity that hasn't appeared yet. Instead of sitting completely still, that money quietly earns something while it waits. The destination hasn't changed. Only the journey has become more efficient.
That's an important difference. For years, people were encouraged to think in extremes, either spend it or invest it. But reality contains a third category, money with a purpose, just not an immediate one. When that money quietly earns a meaningful return, friction inside your financial life begins to shrink. You rely less on expensive debt during unexpected moments, rush fewer decisions. You gain something that's difficult to measure: time. Time to think, time to compare, time to choose carefully instead of urgently. Perhaps that's the real comeback happening in 2026. Not the savings account itself, but patience. In a financial world designed to reward constant motion, there is something surprisingly powerful about allowing certain dollars to stay exactly where they are for a while. Because sometimes the smartest financial decision isn't finding the highest return. It's giving your future choices more room to breathe. The invisible river is still flowing. It always will. But now, there's a quiet place along the bank where some of your money can pause without standing still. And for the first time in years, that pause is finally worth something again. If you enjoy seeing money from a different perspective, consider subscribing.